Good morning. This is Professor Menton, and this is actually the second go around on this one because what I did was I did the whole session, but it came out to about an hour and 11 minutes, which is too long. So, because it takes forever for that to render. So what I'm going to do is I'm going to walk you through all of the transactions that I did, starting with the where we left off before. And so let me go over here to my Exhibit 1. And so what I did was I added into mine all of these customers, okay? And so let me just show you how I did it. If I go to the chart of accounts and go to assets, and these are accounts receivable, but in order for me to do them, because the accounts receivable that they have here didn't allow me to add sub-accounts, I had to do them down here in the other short-term assets. Now, it's real simple to do. And if I'm going to do the edit this account for Jones, what you're going to do is you're going to find the account type, other short-term asset, account name, Jones Building Supply. And if I look at the account ID that I've assigned it, 120-01, that's because it's the first one on my list. And so 120-02 will be the second one on my list, probably Levinson. And then 03 would be the next one on my list. And when I think about my list, again, I'm looking at these guys: Jones, Levinson, Mary Contrary, and so forth. There's only like 5 of them. And do them all as other short-term assets. Now, on these, the vendors, do those as other short-term liability and start out with a 200-01. Now, why is that? All assets start with 100 accounts. That is the 1. They start with a 1. Every single asset account starts with a 1. Every single liability account starts with a 2. And this is for all of them, no matter how small or large your business. If it's a 2, all you have to do is look at that 2 and you know that it's a liability. So what I did was I added a few of these. I haven't added all of them, but I added all of these. Okay? You're supposed to go ahead and add both. Okay? Add all of them. And if I come over here, I'll just pop over here to liabilities to show you what I mean. If I come down here to other short-term liabilities, here I added Joey Johnson Motors. That was the first one on your list, and I gave it a number of 200-01. So anytime you add a new account, and I'll just add one here so you can see it. It pops up other short-term liabilities, and if I come back over here to these guys, I don't think I had anything for master print. So I'll make that 200-03. So master print, count 200-03, and save. It's that simple. And now you notice that I've got master print. Okay. I had Mike's Billboard Supply because that's one that I know I needed. But you should have them all. Okay, just so you get accustomed to how you add these things. Now in the real world, you'd have the ability to add them as sub-accounts to accounts receivable, but this one doesn't give us that opportunity because they want to tie accounts receivable to your bank account, and that's a premium service, and we don't want to add the premium service. So this is a workaround, if you will. We're just kind of thinking out of the box. How do we get these in there without affecting the accounts payable? How do we get the customers in without affecting accounts receivable? And this is just an easy workaround. We just make it another short-term liability. Now, it has to be short-term in both cases. because if you don't put them in as short term, then you can't do your current ratio at the end of the term. You can't do the acid test ratio. And by the way, just so that everybody remembers, this is one of the 5 things that I'm going to take your lowest score on and drop it. So if you're having severe problems with this, and you're doing well on the homework and doing well on the examinations, but at this point you don't know whether you're going to fall out of bed on one of the examinations, so you need to go ahead and do it. There will be a curve applied. I don't expect you to be perfect on this. I just expect you to have some reasonable idea of what you're doing. Okay, and again, one of the things that would really help you, if you haven't done so already, is to make absolutely certain you watch Serial 2 and Serial 3 and Serial 4 if there is one. I'm not sure there's a Serial 4, but make sure you watch those, because they're going to walk you through all of these transactions, how they actually get done. Now I've gone ahead, and since I already did this video, and I've gone ahead and started to apply these new journal entries that we have. All right, so let me go ahead and let me move this thing off the screen so I don't have to look at it. Let's go back to the Exhibit 1 and come down here, and I think that we left off the last time maybe with Levinson. Oops. Oh, come on, Randy. All right, so what I'm going to do is I'm going to walk you through these entries. I'm going to walk you through them as I have made them, and show you kind of how I've done that. And then we're going to, as we go through and we talk about them, I'm going to highlight them. On June the 12th, we created billboard art for Levinson Equipment, $5,000. They paid half the bill in cash. The rest is charged to their account. So let's come over here and look at Levinson's. And what you would have done is you would have came up here and hit this More button and added a journal transaction. I've already done that, and this is the journal transaction. So I'm going to edit it. And you notice here that you're going to write a description, Levinson accounts receivable. You've already added that account to your other short-term assets. And so in this case, here we have $2,500 of Levinson accounts receivable going up. It's on the left-hand side because all assets are on the left-hand side of the assets equal liabilities, excuse me, plus equity. Now, again, all assets starts with the number 1. In this case, Levinson accounts receivable is a sub-account of accounts receivable. But because I can't treat it as a sub-account, I'm treating it as a other current or short-term asset. So I've assigned it 120-02, I believe, because we had Jones as 120-01. Now, half of it they put on their account. That means they're going to pay that later. The other half of it they paid us in cash. So my cash, which is an asset, is going up on the debit side. On the credit side, I have $5,000 worth of revenue. Now, I don't have to have received the cash for it to be charged to revenue. That's called accrual accounting. And it's a requirement for all companies that are traded on the New York Stock Exchange or any of the other exchanges for that matter. it's a required thing, okay? So we start out using accrual accounting. Notice that my total debits are 5,000, my total credits are 5,000, difference is 0. Now I'm going to come back over here and I'm going to highlight, and this is what you should do, highlight this in yellow or some color to indicate that you've done it. The next one, charge Mary Contrary Argument Services $17.50 on for printed brochures. So if I come back over here, here it is. And again, you would come up here and you would hit more and add a journal transaction. I already did the journal transaction. I'm just going to show you the result of it. Mary Contrary Argument Services. This is accounts receivable for Mary Contrary, the sub-account of accounts receivable. Again, I had to do it through other short-term assets. $1,750 on the debit side. It's print advertising revenue. So I have equity in the equation. Assets is equal to liabilities plus equity. The equity section is composed of 4 things. 2 that make it go up, that is revenue and capital contributions, and 2 that make it come down. And the 2 that make it come down are expenses and withdrawals. And in other words, withdrawals are going to be later called dividends. And after you do that entry, you hit save. Make sure you're showing $17.50 on both sides. This is a revenue account. This is an accounts receivable or short-term asset. And again, go over and highlight it. Give it some highlighting color and let you know that and you've already done that transaction. You don't want to repeat it. Returned $50 of office supplies to Weatherly Office Supply and received cash. Okay, so here's what happened. If I come back over here and look up above, I'm not sure exactly, Weatherly Office Supply. We bought $300 worth of office supplies and paid cash. We didn't put it on our account, on accounts payable. We just paid cash for it. So I debited my print supplies expense for my office supplies expense for $300, and I credited cash. Okay, so come back over here to my accounts. If I come down here, here's where I did it. This was the original entry. Office supplies expense, equity's coming down, cash on hand, assets are coming down. All assets go up on the left, come down on the right. Now, I'm not including in that statement I just made contra assets. Contra means against. They go up on the right and down on the left. The only time you're really going to be making a left-hand entry to it is if you are improving that asset somehow and adding additional life to it, or I'm selling it. Now we need to get to the actual entry that's at hand, and that's this one right here. Return some office supplies. So if you want to think about it, I went down to about $300 worth of office supplies that included some toner. Okay, and when I got back to the office with my office supplies, somebody said, hey, this toner is no longer any good because we disposed of the printer that it went to. So please take that $50 worth of office supplies back. Now, when I go back with it, they're going to give me cash of $50, and I'm going to take it out of the office supplies expense account. Okay? Again, my total debits and credits are equal, and I probably should stop here and talk about why I'm doing it this way, because this is the way it gets done in the real world. We don't take it to an asset and then expense part of it off. We take it directly to the expense, okay, because it's usually not material. So I'm trying to give you not just the theory that it goes to the asset, but I'm also trying to give you the practicality, so that when you get out there and you see this, you don't freak out and say, wait a minute, that's supposed to be going to an asset. My book said it's supposed to go to an asset. That's theoretically true, but in the real world it never does. If they are going to set it up as an asset at the end of the period, what they'll do is they'll credit this expense and debit the asset to set it up. So it's done just the opposite of what your book calls for. All right. Come back over to your accounts. Return $50. We've taken care of that now. So, purchase $500 of billboard supplies from Mike's Billboard Supply on account. Use billboard supplies for the debit entry. Alright, so if I come down here, here's Mike's. Again, you're going to come up there to the top, hit more, and then record that journal transaction. I've already done it. This is what it looks like. Billboard supplies expense, debit of $500. Mike's Billboard Supply, a credit of $500 because that's an accounts payable. That's a 200 level account. So we got the supplies. We took them back with us to make these billboards. We haven't paid for them yet. We haven't paid Mike's for them. We're going to pay him in 30 days or whatever. Actually, we'll pay him in July. You don't have July entries, so you don't have to worry about it. Okay, the next one, paid telephone bill. So after I highlight this as having done it, paid the office telephone bill $2.95, AT&T. Again, what you're going to do is come up here and hit more and add a journal transaction. I already did it. Now I'm just going to look at the transaction details. So I put in the description to pay the telephone bill on the 19th. The description is telephone landline, the account. This, by the way, is an expense, $2.95, and I paid it in cash for $2.95. Again, I have total debits and credit agreement, and I have a difference of 0. All right, the next one's a little bit tricky. And what we did was we said, hey, Mary Contrary, we had sent her some brochures. So we had print revenue of $1,750. And if you go back up here someplace, here we go. $1,750 for printed brochures. Now if I come down here and I find Mary Contrary someplace, it's easier sometimes just to look for the amount. This is what we did originally. Mary Contrary Argument Services, accounts receivable now. She owes us money. So we're going to receive cash from her at a later point. So that's an asset, $1,750. This is the revenue side. This makes equity go up. We want to do this every day if we can. And we want to do it 50 times a day, 100 times a day if we could. $1,750. Now what we're doing is we're saying, hey, Mary noticed that there was a typo. There was a typo on the brochures that we sold her. Okay? Since there was a typo, and it was our fault, because it was a typo, she said well, she'd keep the brochures, but only if we gave her an allowance. And the allowance needs to be 10%. Okay? So let's see how we would handle that. Print advertising revenue, because we actually have less of it. Now, in the real world, before some budding accountant out there says something, that would actually go to sales returns and allowances. Okay? Sales returns and allowances, but I didn't have a sales returns and allowance account set up, so I'm using the revenue account itself. I'm just going straight back through the revenue. Usually I'm going to have an allowance account, so I want to see how much of that I'm actually incurring. I want to see how many returns I have, etc. In this case, I'm just going to say this part of the revenue never happened. And so print advertising revenue, 175 debit. That it's a normal credit, so this reduces it. This is the accounts receivable. Notice 175 credit reduces it as well. Now, I'm going to say this and I'm going to go down and show you what the balance sheet looks like on the reports. And if I'm looking at the details now, here's Mary Contrary. Now, notice what I did was I had $1,750 worth of revenue from her, but I gave her an allowance for some brochures that she decided to keep even though they were incorrect. And so now Mary only owes us $1,575 instead of $1,750. All right, back to transactions. The next one is Jerry's. I've taken care of this one, and again, this is a good thing for you to get into when you do something like this, because, or any accounting problem, is to kind of go through and say, okay, I did that one, so you don't do them twice. Bill Jerry's motorcycles for billboard rent, 500 billboards at $800 each. All right. Here's Jerry's. Again, you're going to go to More, Add Journal Transaction. And when you're done, this journal transaction should look like this. The account is Jerry's motorcycle. This is accounts receivable. He's going to pay us something later for the billboard work that we're doing for him. Okay? Remember earlier what we did? We went to Mike's and we got some billboard supplies. Could be some, I don't know, some glue or whatever to hold the billboard on. And we created, with the machine or something, we created this billboard. And we charged him $4,000 for the rent. Now next month we charge $4,000 again. And the month after that, and so forth and so on. That's what that should look like. And again, remember that you can pause this recording anytime you want and actually then, just Paul Parrot what I did. Bill at Joey Johnson Motors for billboard rent, 4 billboards at $1,000 each. And so here it is, $4,000 again. Joey Johnson Motors, $4,000. Billboard revenue, $4,000. Exactly what you did before with Jerry's. The only difference is you have Joey Johnson Motors here instead of Jerry's. Now, let me go back. I want to show you one that I did here on a correcting entry. Just show you how this works. Remember that what I did originally in an earlier video is I wasn't going to put in all of these sub accounts that I've asked you to put in. In other words, I was just going to treat it all as accounts receivable. And then I got to thinking about it and I said, well, maybe that's confusing to students. So what I'm doing here is I'm correcting that entry. In other words, the accounts receivable controlling account, I'm taking it out of there and I'm putting in Jones Building Supplies. So when I look at Jones Building Supplies over here on my reports in the balance sheet, I see that it's now Jones Building Supplies and I don't have accounts receivable up here. There's no accounts receivable. These are all accounts receivable as sub-accounts. In other words, I have gotten rid of the controlling account. All right. Now, if I were to Let's see what it shows if I do the summary. Total other current assets, that all of those accounts receivable are in there. Like Prego, they're all in there. Okay. All right, now the next one, I'm doing one of these for you, and then you get to do the rest of them. And that would be this one on the 26th, the 27th, the 28th, and the 29th. Okay? So, paid the mortgage payment to Tifton Federal Mortgage Company. Use the amortization schedule in Exhibit 2 to make the entry. Split the payment between interest and principal. So I've got to come over here now to my amortization schedules in Exhibit 2. And the one we're talking about is this guy right here. Now, the way that I got this number right here, the way that I got it is just by taking the payment amount, that is the interest rate, and dividing it by 12, because you're going to do it every month, right? Here's June, July, August, so forth. Here are the number of total months, and here's the amount. Now let me make sure that because I think I changed some of this. Paid the mortgage payment. Use the amortization schedule in Exhibit 2. Okay, so I didn't change this one. Good deal. All right, so here's my interest amount. Here's my principal. And I'll just show you again how we do this. In this case, the rate was 6% per year, but we're paying this every month. So it's 6% per year, or 0.06 divided by 12, or 0.005. That's 1/2 of 1%. 240 months. Present value here, this is the number of periods, by the way. Present value of 320,000, that's what we owe on it. And now, what I could do, because I want this to show up as a positive number anyway, I'm going to put this in as a negative number. And when I do that, it changes this to a positive number, which I needed to do anyway. All right? And now I'm going to have to redo my amortization schedule. So the principal is going to be equal to this number. And this number is going to be a constant. And for me to make it a constant, notice up here I have $, D, $4. I can put it in that way, or I could simply hit F4, which does it for me, minus the interest. And you notice now I got $692.58, and my ending balance is slightly less, and it's actually $320 minus the principal. That's the way that gets calculated. My ending balance then at the end of June becomes my beginning balance over here. So what I'm going to need to do to change this amortization schedule is to come down here like that. And then I'm going to take this whole group and I just double click that. Okay? And it changes it. And if I come down here to the bottom, the only difference really was that I made the payment a positive number instead of a negative number. Just easier to deal with. Notice that at the end of the term here in 2042, I'll have a zero balance. So I will have paid that all off. Now, important for you to realize is that here are the numbers you're dealing with. Actually, just these two. Because this is June, and we're only doing 1 month. I'm going to save this, by the way. I've changed it. So, paid the mortgage payment, Tifton Federal Mortgage, use the amortization schedule, Exhibit 2 to make the entry, split the difference. All right. So now let's go back over to waive. Here's your building mortgage. I should have been a little bit clearer, I think, on my write-up there, and I will fix that for future groups, okay? This actually happened on the 26th, not on the 30th, so I need to change that. You're again going to go to more, and then you will make the following entry. Interest expense, $1,600. Notes payable buildings, current, $692.58, and cash is going to be reduced by the amount of the payment of $2292.58. Now, on your amortization schedule, I can get back to it. And what I did was I went ahead and I think I did them all for you. And so you can see, you should try to do this. You should try to make sure you can do this entry or this formula, because it's really important. If you're trying to figure out, let's just say you were going to borrow $320,000 at 6%, that's the way it would look, absent, of course, your taxes, any taxes that you have, any escrows that you have to put in. Okay, so it would be the actual payment will be higher if you were to actually borrow money for a house or a car or whatever. It's going to be a little bit higher because of insurance and so forth. They force the insurance. Okay, if you buy a house from them or finance a house, finance a car, or whatever, if you don't have insurance, they force it, and so they'll just take it out of the payment. Okay, they treat that as like an escrow. But again, on any of these that you do, you're going to start out by taking the beginning balance. That's your present value. This is the interest that you'll calculate. This is the principal. And this is the ending balance. Notice that always the ending balance is less by that number. This number then becomes your beginning balance. And then you'll drag it down. You'll drag this guy down one level, and then you'll drag this guy, once you've done that, down the rest of the way. Or you can just come here to the where this fat cross becomes a skinny cross, and double click it, and it will automatically calculate all of the remainder of those items. Okay. Now, I'm not going to do the rest of them. I'm not going to do the rest of these payments. I'm going to let you do them. Instead, I'm going to come down here, and you do this one, and this one. And this is the one I'm going to do for you for depreciation. Record depreciation for other vehicles. Assume a $50,000 cost, 3-year remaining useful life, and a salvage value of $5,000. The formula to calculate depreciation is the initial cost minus the salvage value divided by the useful life. Now you can do useful life in years, or you can do it in months. Since we're doing this every month, you need to do it in months. So if I pop over here to my amortization schedule, we're going to talk about that $50,000. Now, let me just point out to you that we didn't finance that much. Those don't have to be the same number. Okay? I could have made them the same number, but I didn't. So I've chosen to have a beginning balance of $30,000, which you would find if you come over here to the top. The owner brought business several with the original cost of $120 as of the date. They transferred in $30,000 at 12% over 3 years, was still owed. So that doesn't have to equal the salvage value or the cost. in this case, I don't have 120,000. I only transferred in that portion of them that was not already depreciated. Okay. And again, I probably need to go back and be a little bit clearer on that. But if you just follow what I've given you, you should be fine. So here's the $50,000 cost that I've given you. Here's the $5,000 salvage that I've given you. And this would be the yearly amount of depreciation. And you can see that because if I take 50,000 minus 5,000, and you have to do those two first. So if you look at my equation up here, you see that I have equal, and I have an open parentheses, y5, that's this guy, minus y6, that's this guy, close parentheses. So I'd have to have that done first, divided by 3. That gives me 15,000. Now if I then turn around and divide this number equal this number divided by 12, that gives me my monthly depreciation, and we're only doing the month. So that's 1,250. If I go back over to my wave, depreciation on existing vehicles, and again you'll do it from this more and then drop down and do the transaction. This will look like this, and they'll all look like this. The only difference is going to be the accumulated depreciation. This one says vehicles. The next one might say building. And the next one might say equipment or furniture or whatever. And you'll just do each one of those depreciation amounts. Again, refer back to your book if you don't understand how to do the formula, but that's the way that it gets done. And now if I come over here to my reports and I do the balance sheet, I see that all of these things have been taken into effect for the balance sheet. Got 754, 460, 25. You'll not have that. But if you do it exactly like I've done it, you should be able to check yourself and know that you're doing it right to that point. Back to reports. Let's take a look at the profit and loss statement. Here are all your revenue accounts. Your print, that's not going to change. So this is the number you're looking for. When all's said and done, you're looking for total income of 16,075. Now, what will change are these operating expenses. Why? Because of the depreciation expense and the interest expense that you're going to add when you do the rest of those accounts. In other words, when you do the remaining, when you pay the other three short-term liabilities, and when you actually do the depreciation expense for the remainder of these. So if I come back over here, I paid that one. You have to do this one, and this one. I did this one for you. You'll have to do the remaining 3 or 4. And then you'll follow these instructions down here. The ones that I'm really concerned about or interested in, I want to make sure you have this trial balance, the income statement, the balance sheet for the month of June. If you have those, I'm not going to worry so much about the rest of it. But if you didn't do this one, you cannot possibly be able to do this one the rest of the way. You can't do it. You have to have done that first entry. And I walked you through that entire entry, so you shouldn't have any problem doing it. Okay. If there are any other questions, just email me, and if I think that it's a question that everybody probably has, then I'll post something else for you. But with this, you should be able to finish this project. But again, if you can't, just let me know, and I'll help you out the rest of the way. So this is about a 40-minute video, and it was an hour and 10 minutes or an hour and 11 minutes, so they've cut it back fairly substantially by doing it this way. All right, see you next